Markets are looking exhausted. Triple witching just took place, trillions of dollars at stake, and technology led to the downside in what was an ugly day for the market. So is this the start of an extended rally to the downside? Short-term moving averages are looking weak, and we need to talk about what happens when this year's winners start selling off. We're also going to be discussing the value rotation, what the future holds for the Russell 2000, and we're going to be taking a look at the latest addition in the public portfolio. The portfolio is up 7.92% since inception last Monday, and I believe there's plenty of upside left. So with the S&P 500 closing the weekly candle with an ugly long leg doji, is this the end for what has been a spectacular rally since the October lows? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe. Like this video. Guys, leave a comment. It really helps me with the algorithm. You know how it works already. Let's get into it. Looking at the S&P 500 heat map, pretty rough day here for software application, down like 2.5% for the sector. Semiconductors actually not too bad. I mean, AMD did pretty well. Same with Micron. I think a lot of people are buying into their earnings next week. Broadcom continues to sell off after its earnings, and Nvidia down 0.12%. Infrastructure tech not too good as well. Apple hardly participated. Google and Meta in comm services were down 1.5% and Amazon 2.42%. Very rough day in these mega cap 7 tech names. We saw financials do all right. I mean, the big names, Berkshire, JP Morgan, putting up some pretty solid numbers for the day. Visa and MasterCard took it on the chin. And then we had a very mixed day in the rest of the sectors. Look at industrials, fairly green, some red, some green. That's how the market goes. Same here with staples. Healthcare too. Energy was kind of flat. Refineries did pretty good. Utilities were pretty green, and it was a very, very mixed day of trade. Looking at the actual majors though, the IWM was actually up for the day. Mid caps slightly down for the day, 0.15%. The S&P 500 and the Nasdaq were the big ones though. When the mega caps don't participate, you really see downside flows, down 1.5% here in the NDX and 0.65% in the S&P 500. And these big markets are just looking a bit exhausted at the top. Let's hop on the charts and I'll show you what I mean. So this is the weekly chart of the S&P 500, and just you do the eye test when you look at something like this. Look at these wicks on the top and the bottom, and look at this candle structure. We can see this does scream exhaustion right here, because if we actually look back at the last 3 months, we haven't seen candles like these, wicks like this. I mean, for the most part, when we did get long wicks, it was to the downside right here. And last time we actually saw price action that looked very similar to this, sort of around here, this was like early 2023, May 2023. This type of price action, the market does look a little bit exhausted here. Now, on a weekly chart, I do want to point out, guys, that I remain 100% convicted bullish up until the 47.95 area breaks. The reason why it's a key level is simply because it was the all-time high here in 2021. So on a weekly basis, like, we could pull back to this 47.95 level right here and still be 100% bullish and be in a technical uptrend. So we could pull back here, find bullish demand, and it would just serve as a great buying opportunity for us to continue higher, be a good pullback in price. To be honest, I hope we get there. I really hope we do. I'll be adding a lot at this 47.95 level, especially in my ETF portfolio. Now, if we actually hop on the Nasdaq, very, very similar situation, looking a bit weaker than the S&P 500. You can see we are looking quite a bit exhausted at the top. Less lower wicks, more upper wicks, and that's simply because this index has a ton of tech stocks. They've run up the most. They've really been the outperformers. When they do outperform to the upside, they can pull back a little bit more than the rest of the market. But I'm not going to dive into the Nasdaq explicitly. We're going to do that in the weekend video. This is still the daily recap video where we mostly just look at the S&P 500. Now, we do know that 47.95 is the key level on the weekly chart. Hopping on the daily chart, we can see a couple of very, very key things. Now, we are still in a technical uptrend, guys. I mean, we are making higher highs at the same time making higher lows, and we are in an uptrend. Now, actually zooming in on today's trade this week, this was the low of the week. This was Friday's trade. Now, looking at candle structure and location, we actually didn't go ahead and break the week's low. However, I did say in yesterday's video, if the bears do want to make a move, they do need to get price to the low of Thursday and then maybe even close at that level or below. That's exactly what they did. And short-term moving averages are pointing to some downside. I cover that later on in the video, in the breadth section of the video. So we could actually potentially see some downside momentum in the market, but it's going to be predicated on a couple of things. The bear case is very, very simple. This level right here, the 50 50.90 level is absolutely key for bears to go ahead and take very early on in the week. What bears need to do is push to this level, push below, use as resistance to continue the downside momentum. Let's say they do that. What levels are bears going to go ahead and look at? Well, the first level they want to also go and break is this 50.57 level. Let's call it the 50.50 level. And then from there, the bears actually want to go ahead and close this gap right there. On a daily basis, I do think that this is probably the next biggest section where bulls will come in a very, very strong way. Why? Because it's just below the 5,000 level, and it was where we had this massive Nvidia gap up. And I think a lot of people are going to look at this as immense value, especially in the S&P 500, and go ahead and actually add a lot right here. So, if we do pull back below this 50.90 level in the S&P 500, do expect some downside flows early into late next week to as low as the 48.92 level. Now, if we do go ahead and break this level next week, and if that does happen, it is going to be quite significant, because from where we are right now to that level, it's 2.6% to get to the 49.83. Now, 100% possible. It is 100% possible. We could even do that in one day. I've seen crazier things happen. And if we do get below the 49.82 level next week, maybe even a weekly close below, then that does open the 47.95 area. However, we're still a while from there, and we're going to take it day by day, week by week. And as it stands right now, bears firstly have to go capture the 50.90 level. Now, the bull case is very, very simple. Bulls just need to hold the 50.90 level, and everything is predicated on this level. If bulls hold this level early next week, I think we're just going to balance above it. We might have a little bit of price action below, but for the most part, we're going to balance above it if we hold it very early on in the week. I'm talking Monday, Tuesday. We do that, and I think we just have a correction in time for the next couple of weeks as we are in this window of weakness and we exit March. So that's what I'm thinking for the S&P 500. That being said, we are still in a technical uptrend on the daily chart, on the weekly chart, and even on the monthly chart, but the monthly candle hasn't closed. So those are my thoughts for next week in the S&P 500. Markets looking exhausted. Key levels at 50.90, 50.50, and 49.82. Below 49.82, it does get a bit grim. What the bulls need to do is hold that 50.90 level, or we will see downside flows in this window of weakness. Now, looking at sectors, guys, like looking at this chart, there was no real leader. I mean, tech did take it on the chin here. Software, look at technology, XLC, XLY. They were the only sectors underperforming the SPY. But what outperformed the SPY was like semiconductors, healthcare, financials, still in the red though. But then you actually have a look at like XLF, right? Look at the financials, only down 0.1% considering where the SPY was. And then real estate, XLP, pretty much flat. And then GDX was literally flat. And then, industrials gained, materials gained, utilities gained, energy gained, regional banks, home builders, XME gained. But there was no real leader, guys. We had cyclical, sensitives, defensives up here, outperforming, the SPY actually gaining for the day. And then we mostly just had like sensitive technology names underperforming. And yeah, they're the ones that have run up the most, and they're probably the ones, if we do pull back, are going to take it the most on the chin. It is what it is. That's how the market goes. These are the strongest names in the sector. They have the best balance sheet, the best growth prospects for now. They're expected to grow Q1 earnings at 34%. So, you should just look at pullbacks, look at buying quality names like Google, like Meta, like Microsoft, if they do pull back 10 or so percent for the most part. Moving on. Now, guys, we're going to look at earnings of a company called GCT. Now, this is actually a trade I called out on the 14th of February. I said a while ago, hey, I'm long GCT, and I built out a position in this stock for my really long-term portfolio as well as my retirement account. Now, they reported earnings, and let's have a look at it. It was a blockbuster earnings. EPS came in at 0.87. The market was expecting 0.58%. We actually saw revenue soared by 94% on a year-over-year basis. Gross profit was up 164%, and margins improved to 28.5%. And if you guys actually know what this business does, its operational efficiency from the start of its chain to the end of its chain is absolutely incredible, because it's got the entire system integrated from warehousing, merchandising, all the way down to payments and delivery execution. And that's why it can have such high margins, because it's got everything so efficiently managed. Net income increased 184% year over year to 35.6 million. Adjusted EBITDA up 182%, and its 3P sellers and buyers on the GigaCloud marketplace increased significantly. And this is the major thing. I think it went from something like 350 sellers to like 550, and then its buyers was also like up like 70%, some crazy. And then the market was expecting a 210 million Q1 guide. It guided for 230 and 240 million. The street absolutely loved it. It was up 23% on the day at $43, down ever so slightly after hours, but a blockbuster earnings here for GigaCloud. And I actually added a bit of this to my public portfolio. So right now the account consists of Google right here, GigaCloud Technologies. I added it yesterday after the earnings into this portfolio. So it's a $517 position. We're up 13%, and the total return for the portfolio since starting on Monday is up 7.92%, $72 total return, and the current value is $984. That is US dollars. Now, I do have a significantly bigger position. My actual average cost for GigaCloud is about $27, somewhere around there, and I think I'm going to keep adding because I do think that GigaCloud is actually critically undervalued. Now, I'm not going to run down the entire business, but I am going to go through a discounted cash flow analysis right here. This is the current ticker right here, and if you guys want this spreadsheet, let me know and I'll make it available to you guys. I'll send you a link. Now, you can see it's increased its cash flow every single year quite significantly. For full year 2023, that was its free cash flow figure, $133 million in free cash flow. Now, I've made some assumptions. Now, the average growth rate for this company is about 500% per year. Now, I'm going to use 10%. The street expects about 25%. So we're going to build a bit of margin of safety there. We're going to use a 10% discount rate. Now, this is actually the cost of capital. The thing is, I put total debt right here for GigaCloud at 120 million, but that's just their capital leases. They actually have zero long-term debt. They have no long-term debt. So really, you could use this figure right here at about 5%. You could use their cost of equity over their cost of capital, but we're going to use a 10% discount rate, a 0% terminal rate. This is how much cash they have, 183 million, and we use debt at 120 million. Although, let's be real, you could probably use this at 0 and then 40 million shares outstanding. That puts a fair value at $75, call it 76, 75.95, and we're looking at a stock that's 43% under its current fair value. So at its current price with its current metrics, it's 43% under fair value. And if we were to use like actual metrics that it's going to grow by, let's be like, let's say 15%, we then use a 2% terminal rate, and then we actually use a discount rate of 8%. You're looking at a stock that should be fairly valued at $124. But this is really like the best case scenario. I prefer using the base case, which is a 10% discount rate, 10% growth rate, and fair value is at $75 right now. And even at a 0% terminal, that means that after 2028, the stock is set to grow at 0%, and it's still well under fair value. So I do think that even after this earnings, adding all the way up to $50 is a very, very prudent price. There are risks to this stock though, but I might cover those in the weekend video. This is still the daily recap video, and we have gone over one of my major positions. So yeah, the GigaCloud technology, very, very happy right here. I'm glad it's in the public portfolio and we managed to get some of these gains yesterday. I added it last night, but yeah, still very, very happy with this position, happy with the portfolio. I think we get the next round of revenue on the 22nd of March, somewhere around then, and then we might just add more to this name or Google, or we might even look at PayPal. That's another stock I'm really deciding if I should put it into the public portfolio or not. That being said, public portfolio is doing really, really well, up 7.92%, and a good year so far. And I think this public portfolio is shaping up to be really, really good, really, really fun. I hope you guys are enjoying this. If you do like the public portfolio, let me know in the comments below if it's something you want me to continue, if you like seeing the trades, and complete transparency with the public portfolio. So I got some incredible stats right here. It's S&P 500 forward returns after 2% drawdown in March. Now it says 2% right there. This data is actually a 1 to 2% drawdown. So in that range, normally it's very, very positive. Average return 9.3% from April to December. That's a 9-month return. That's about 1% per month. That's kind of great. Then you're looking at a 1 year, 12-month later return, 15.7%, 87% hit rate, 91% hit rate. And the worst 6 months was about 3.5% return. And then the best 6 months was 11.9%. So very positive stats. If we do get a significant pullback here in March, especially after OPEX, we can just look for dip buying opportunities because history is on our side. Now let's talk about value. This is Russell 2000 blended earnings growth for Q4 2023, this earnings season, something we don't really keep track of a lot on this channel, and we probably should because I do have access to the data for it. And we can see right here, the Russell 2000 has reported negative 1.5% revenue growth, excluding energy negative 0.8%. The earnings, however, negative 17.6%, ex energy negative 12.5%. So, earnings are coming in slightly below what it was last quarter, year over year figures, by the way. But then we actually have a look at the transition into earnings. So how does that revenue translate into earnings? And it's not very good. And we do know that a lot of companies in the Russell 2000 have a ton of debt on their balance sheet, 40% unprofitable. It's a lot of floating rate debt. So they're paying anywhere 4% plus on their debt right now. And that's why earnings are not quite as great as revenue. With S&P 500 companies, we've seen increased revenue and even further earnings because they can buy back shares, that sort of thing, cut costs. They have market leading positions. Not so much here for companies in the Russell 2000. And that's just what you get when you invest in the Russell 2000. However, 1,616 companies have reported. There's still about 25% of the Russell left to report. So we're going to keep track of them this earnings season. Now looking at Russell 2000 valuation, still historically cheap. We're sitting at about the average valuation here for the Russell 2000, and that's about 15 times earnings on a forward PE basis. And I still think it's largely attractive, because if we actually have a look at the absolute forward returns of the Russell 2000 at a 15 PE, we're sitting at about this region right here, and it's very close to double-digit returns for the next 10 years. It's about 9% annualized returns for the next 10 years, and that's actually really, really good. You'll go ahead, beat inflation, you'll beat bonds with those returns, but I think you can get even further outsized returns by just looking at small cap quality or the S&P 600. They trade at roughly the same valuation, and you're just getting higher quality companies, better cash flow, better earnings, and lower leverage. And all things considered, it's absolutely essential to have small cap and even mid cap exposure at these valuations, especially with where large caps and the S&P 500 trades on a PE basis. Now, I want to talk about the growth and value trade, because I really do think that in the next 2 to 3 months, I think value is going to outperform growth, and I think we're starting to see the early signs of that. Now, normally, after the first Fed cut, value led growth for 6 months, smalls led large, 3, 6, and 12 month, and bonds led stocks. Now, this right here is when the Fed cut rates, and we can actually see that after the Fed cuts, what we normally get is that value leads growth up to 6 months later, and then we actually have growth beat value 12 months later. Now, that's not to say growth has a negative return, it's just that value outperforms growth. We can see that 6 months and 12 months after, small caps do go ahead and lead large caps, but large caps do outperform small caps 1 month, 3 months later, and then in aggregate, bonds outperform stocks after Fed rate cuts in general. So if the Fed does go ahead and cut rates this June, July era, it's probably good to have a decent allocation to bonds, especially longer term bonds, medium term bonds, as well as stocks. And leading up to that Fed rate cut, it's probably best to be in large caps, because we do see outperformance in large caps into the rate cut, as well as 3 months after, and then smalls only outperform. And generally speaking, it's also good just to hold bonds for the most part. And I do think yields are attractive, and if you do want to go ahead and hold bonds, that's not necessarily a bad thing. But moving on, this is S&P 500 sectors outperformance hit rate around the first Fed cut. So the percentage of times sectors outperform the S&P 500 around the first Fed rate cut. We're about 3 months away from a Fed rate cut. What normally outperforms? We're looking at staples, energy, financials. What do all of those things have in common? Value. These are value stocks. And this is why I think over the next 2 to 3 months, value is going to outperform. Like I said before, value outperforms 3 months after. We can see the same hit rate here 1 month before the Fed rate cut. We can also see comm services, right? 89% of the time. Now, if you actually go look at Meta and Google, right, they're not grossly overvalued like most companies in the tech sector. I would say that there's a bit of value to be had, especially in Google. So we can definitely look at value outperforming leading into the Fed rate cut. And then after the cut, it gets a bit more growth orientated. You can see that tech and industrials outperform. And then 6 months later, we have tech, materials, real estate outperforming. And then 12 months later, you really have technology, materials outperforming the S&P 500. And we actually do see quite a lot of leadership here in real estate. So what outperforms? Rate sensitive names, growth names 6 months after the Fed rate cut. But leading into it, you definitely see the value trade take part. And that is why I think over the next 2 months, we're going to have a breather in growth. Value is going to outperform. The data is going to come in strong. And hopefully we get those Fed rate cuts June, July, maybe as early as May. And then we can get back to regularly scheduled programming. Now, I showed you the Russell 2000 10-year annualized growth. We're looking at about 9% for the RTY. This is the market implied long-term growth, and it's for the S&P 500. And you can see here that right now we're sitting at about 11% S&P 500 growth expectations. Not bad at all. So, put your money right here, right now, and you can expect about 11% return. I think this is for the next 10 years. It does say long term, but these are subject to change because in the year 2000, the S&P 500 was priced for 16% growth for the next 10 years. Right now, we're priced for 11%. Post-COVID, we were doing 13%. So it can come down, as you can see. That being said, the actual long-term average is about 9 to 10%. If we do push down to these levels right here, don't be surprised. I still think if you take a very, very long-term outlook on your investments, dollar cost average every single week into the S&P 500, you'll outperform most indices, fund managers, traders, and investors. Now, looking at valuation from a price to earnings standpoint, the S&P 500 or the entire US market trades at 21.3, a bit pricey. I've seen other numbers come in at like 20.6x. So take these with a grain of salt. Maybe they're slightly overvalued. The whole world is trading at 18.6. I think this right here is all countries excluding the US is trading at 17.6, Japan at 15.9, which is crazy considering the earnings revisions we're seeing in the Japan market. And then Europe is trading at 13.5. I would love to know what this is Europe excluding the UK. And then we have emerging markets here trading at 11.9 PE. So a lot of value here in emerging markets. I do think it's good to have a diversified portfolio across these asset classes. But really, if I were you, I'd really look at like the US, Japan, and potentially Europe. Maybe not so much UK because the earnings situation in the UK is not the best. There's some really great countries you can put your money in that have really outperformed the Europe market as a whole. Stuff like Germany, stuff like Switzerland, stuff like Sweden, the Netherlands. Or you can look at stuff like the granolas. Those are just like the top 10 biggest stocks in Europe. And it includes companies like Nestle, ASML, SAP, Sanofi. Great companies when you look at it. We got some very unexpected data here from BofA. Global equities just recorded their largest inflows in 3 years, totaling $54.26 billion. And last time we actually saw a figure this big was around March 2022. It was pretty much that COVID rally, end of 2021, early 2022 high. That's when we saw this much inflows into equities. So this could be a top signal, but somewhat of an unreliable top signal, because sometimes people just have more money after stuff like tax refunds or bonuses, or they just come across a lot of money and it all just flows into equities in 1 week. If you actually want to look at a much more reliable top signal, this is one I track almost every single week, and it's essentially FINRA margin debt balance ratios. So all it is margin debt divided by the currency in circulation in red. So it's pretty much this FINRA margin debt divided by M2, the money supply. And pretty much when you get to these peaks right here, here, and here, right, that's when you could say, okay, things are getting frothy. People are using a lot of leverage. You can see the same year in 2008, the same year in the early 2000 tech bubble. And at the moment, we're not quite there. Maybe it's because of the inflow of M2 we've had in the last 18 months. Maybe it's the restrictiveness of monetary policy, but the same frothiness we saw here at the end of 2021, start of 2022, when we did go on that massive 26% skid in the S&P 500, that same frothiness is not quite there. Once we do start to see this margin debt ratio a tick up closer to this 0.36, 0.4, 0.42 level, that's when we could start really taking our cards off the table and really look at selling into any rips rather than just buying any dips. And until that happens, this market will definitely pull back for sure, but all pullbacks will be short-lived, and we will continue the grind higher. Now, guys, back to sector analysis. Yesterday, we did a deep dive into sectors against the S&P 500, what performed better. Now, this is kind of crazy because for the most part, all sectors are doing really, really well. It's just some are doing better against the S&P 500. And 7 of the S&P 500's 11 sectors are within 5% of record highs. The other sectors are pretty much at record highs, and this is absolutely crazy. I think the sector that's furthest away from its record high is actually the energy sector, and it's 7.5% away from all-time high. So guys, this is very, very bullish. These are bullish statistics. This is not a reason to become contrarian. When you see the whole market rallying like this, breadth is there, and it's a very bullish market, and any pullbacks we do see in the market should just be looked as dip buying opportunities because stocks are on a huge rally, and I do think this is really going to continue despite the elevated valuations. Now guys, we got some research here from Apollo. This is with regards to credit investors. I'm just going to read the key points here. So they say M&A volumes picked up in February, a trend they expect to continue amid an improving macro backdrop, elevated PE, dry powder, and near record cash on US corporate balance sheets. MMA-driven issuance weighed on US IG valuations and spreads. All-in yields remain attractive and should continue to attract retail, insurance, and pension flows. Credit spreads should not react negatively if market expectations for Fed cuts this year decline further. However, rates higher for longer could pose risk for companies with low interest coverage ratios. That's Russell 2000 companies right there, especially those with loan-heavy capital structures and or near-term maturity walls. So if the Fed keeps pushing rate cuts out further and further because of the data that's coming in, stuff like real estate, rate-sensitive sectors are not going to do so well, and smaller cap names, even some mid-cap names, might not do so well. It does benefit you to hold a diversified portfolio across sectors, across size of equity investment and across countries. So all in all, have a diversified portfolio. It will benefit you amid all of the structural trends, tailwinds, and headwinds we're seeing in the market right now. Now, looking at seasonality, this is how we're tracking for March. We're sort of tracking the March seasonal period pretty well. We kind of just buy dips, sell rips all the way, make our way higher in March. And that's kind of what we're doing right now. March has been more volatile than February and January. That being said, we are positive for the month of March. We're sitting at about a 1.1% gain right now. And according to the seasonal period right here, we're about halfway through March. We should track higher even despite what normally happens in OPEX and the window of weakness. Looking at breadth across the major indices, looking at stuff like the 5-day and 10-day moving average across all of these indices, the S&P 500, Nasdaq, Dow Jones, price action is trading below the 5-day and the 10-day, and in some instances the 20-day. Short-term moving averages have been violated, and this just goes to show that after today's price action and after this week's price action, the bears have violated these levels. Now, for sustained momentum to the downside, the bears really want to go ahead and take the 50-day moving average. That's really a big one. But as it stands right now, shorter term averages are signaling some bearish momentum is building in the market right here. But longer term, we're still looking really, really good. Now, looking at a couple of other charts, the core market model has officially entered extreme overbought territory. When this normally happens right here, and here, we do actually get a little bit of a pullback, but in very strong market trends, these pullbacks are very short-lived, and we do normally continue the rally. The pullback is there just for a bit of a breather, and the pullback is normally one in price. We have a sharp pullback followed by a sharp rally very, very quickly, just to work off some of these overbought conditions. Now, this right here is more evidence supporting the growth versus value trade. Now, this is IWF and IWD. So it's actually like large cap, mid cap value against large cap, mid cap growth. And when this goes down, value outperforms. When it goes up, growth outperforms. And we could see that we are approaching this critical trend line right here. And if we do break below, use as resistance, and then continue lower, we could see value outperform over the next 2 to 3 months into the rate cuts, where we know value does typically outperform up to 6 months after. Looking at NYSE composite, and I got a bunch of these charts, and guys, despite the volatility we've seen this week and in the month of March, right, new lows haven't accelerated. In fact, new lows have actually gone down. So we've got like short-term lows right here and then like midterm lows. And the same is actually true here for the Nasdaq composite. The same is true for the S&P 500, and the same is true for the Russell 2000. Now, looking at the S&P 500, this is number of days prior to the start of a 5% correction, 10% correction, and 20% correction. And normally between each 5% correction, we have about 67 days. It's been about 90 days. So if we actually do go ahead and pull back 5%, right? I know the bears are going to like screech their head off talking about 2022 COVID lows. But if we do go ahead and actually pull back 5%, it's actually kind of due. The same is true here for a 10% correction. We normally get one every 90 days. We haven't had one for 291 days. And then a 20% correction, we get one every 823 days, and there's still a while to go. So anywhere from a 5 to 10% correction seems very, very plausible anywhere between today and like the next month or so. If we do get, a 5% to as far as 10%, that would be 100% normal and actually expected. Now, looking at some risk on, risk off charts, high beta versus low volatility, we've seen high beta take a breather at the top here, but all in all, if we look at the chart as a whole, these are 3-month charts, I believe it is on the up and up. The same is true for cyclicals versus defensives, and we see cyclicals still trending here at the top. Now, discretionary versus staples, we have seen a bit of a turn in the last couple of days, but staples has outperformed discretionary for March for the most part, but in the last 3 months, it's been one-way traffic. Now, looking at the US dollar, it is inverted right here, and generally speaking, when this chart has gone down, the S&P 500 has gone up, and we have seen a bit of a turn here. The market has completely ignored that and just rallied as a result. So maybe we do pull back a little bit in the S&P 500 against this chart. It would be perfectly normal, but this is just one piece of the puzzle. Looking at S&P 500 advanced decline line, we continue to make new all-time highs in the AD line. Breadth is great. I showed you the breadth charts just earlier. And looking at high yield bonds versus treasury bonds, we've seen a snapback here in high yield. People like risk on. This is a huge risk on signal, especially in the credit markets, and it extends to the S&P 500, and we can see this is the case right here. If we do go ahead and break these highs, that probably means credit spreads will continue to tighten in the credit markets, and that will continue to support equities. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment. Cheers.